Hello and welcome. Here we are today with Ben Ritchie, Head of European Equities of Aberdeen Standard Investment. Today he's going to talk about the European Equity Fund. Hello, Ben.
Hi there.
The European Equity Fund has had very good results in the past few years. Can you tell us something about the investment strategy, your team, and the reasons why you think you achieved those results?
Well, we've had a good run over the last nearly 5 years since I took on leading the strategy in 2015. And I think the main drivers behind that have been a very, very strong research capability, which is covering the breadth of European equities, also generating significantly insightful research that can generate really good ideas. It's a very focused fund, so we have just over 30 holdings in the portfolio. And it's a very consistent approach. So we're very much focused on finding the best companies in Europe at valuations which we think can deliver good returns to our investors. And so we think it's a very clear proposition. We've executed consistently over the last 4 or 5 years. And we think that's really been at the heart of why we've been able to deliver good performance through both up markets and down markets over the last 4 or 5 years.
Some investors are disappointed with the relative performance of European equities. Do you find value in European equities at this stage?
Well, I think investors are probably right to be disappointed with European equities. If you think back since 2011, earnings in Europe have grown at only just over 2% per annum over that time period, which is partly explains why Europe has underperformed the United States over that time. But we still see a lot of attractive opportunities within Europe, but you have to be very specific. If you look at the broader market, I don't find it that attractive. But if you're prepared to look at segments of it, and particularly the kind of world-class businesses which we're looking to put into our portfolio, then we still think there are good opportunities. And when we look at the potential returns that are out there, we still see the ability to generate prospective returns in the double-digit plus from the kind of companies which we're investing in. And while the multiples on those companies might be relatively full, we still see strong, sustainable growth coming from them. And from that, we believe we can still generate good returns over the long term.
And what do you think are the most important structural drivers for the European companies nowadays?
Well, it's really interesting because if you spend your time focusing on the macroeconomics and the politics in Europe, you just get very depressed because it's never really going to be that exciting. But if you look at what the key structural drivers are for many of these companies, then that offers much more significant growth. So some of the areas where we find quite attractive opportunities would be in areas like consumer brands, where again we've got world-class companies like L'Oreal, Nestle, Heineken selling their products globally, growing revenues at good rates, much better than you'd get just selling them in Europe. We see a major shift in digitalization. So Europe may not have the Googles and Microsofts, but it has a lot of smaller technology companies and software and platform areas, which again can be very, very successful companies. Businesses like ASML are truly world leaders in what they do in that area. And again, we also see demographics as a big driver of opportunity for European companies. So, the global population is growing. That can drive companies like Unilever that are selling soap and shampoo in markets like India. It can power companies like Prudential that are selling more insurance products in Asia. But also with a population that's getting older, can create opportunities for companies that are doing things like selling spectacles, such as EssilorLuxottica, or Amplifon, which is one of the world's leading retailers of hearing aids. So we see those kind of attractive opportunities, and that's much more interesting for us as investors than talking about Brexit or European politics.
Okay, and finally, what about ESG and the quality focus that you put on your investment?
I mean, ESG has always been a big part of our investing for a long time. It's really been part of our culture over the last 20 or 30 years. It's become much more popular in recent times. I think it would be fair to say that historically our focus was more on governance than on the environmental and social issues. But with part of our quality focus, ESG is one of the things which we grade all of our companies on. And so companies that have poor ESG don't make it into the portfolio. And as a result, we see that as really as a risk management tool for us, avoiding things that can go wrong. The fund itself, I think, gets a AAA rating from MSCI, so we actually do what we say in terms of focusing on ESG issues. And increasingly, it's moving not just from a risk management thing and avoiding problems, but ESG is also becoming a growth driver. It's one of the areas where European companies outperform their US and emerging market counterparts. And over the last 4 or 5 years, we've started to see strategies strategies that focus on ESG outperforming, and we're starting to see trends in areas like renewables, within areas of utilities, within areas of electronics, insulation, those types of areas where there are some quite interesting ESG drivers for companies, and potentially that's also going to create investment opportunities as well as managing risks.
Okay, thank you very much for coming.
Thank you.